Right, hello everyone. Okay, so in this video we're going to be going over income tax and other deductions. So when you are a working person, you are getting paid for your work, and within that, within your wages, you are going to be losing a lot of that money to taxes, right? So what is income tax? So income tax is a tax on the money you earn, which is used to fund government programs and services such as education, healthcare, defense, social security, and welfare programs. So after you calculate that, so your gross pay is the money you have made before any deductions such as taxes, right? So your gross pay, so gross as in it's the money you have before things are taken out. So income tax is banded. So we have our standard rate of tax, or our lower rate of tax. So this tax rate that applies to a majority of your taxable income. Then you have your higher rate of tax, right? So your higher rate of tax is if you are making more money, if you are making over a certain threshold of money, you are being charged a higher percentage on what you earned over that threshold. So for example, there might be a 50% income tax on any money you earn over €100,000. So you're not being charged 50% on the 100,000, but you're being charged 50% tax on all the money you earn after that 100,000. So say, for example, you're on 150,000, you are paying 50% taxes on that 50,000 over the 150 or over the 100,000. So that is known as a standard rate cutoff point. So the standard rate cutoff point is the income level above which you should start paying higher rates of tax. So I think in Ireland now it's like 33,000 ish. So if you're earning more than 33,000, you are then paying higher rates of tax on stuff you earn over that. So gross tax is then the total amount of tax you have before any deductions or credits are applied. So we have tax credits. So tax credits in terms are just a discount on your tax. So I think everyone gets a tax credit for like €3,500 a year. So you pay a lot of tax, but you will get a discount of 3,500 on that. So when we subtract our gross tax and our tax credits, we get our tax payable. So that is known as a tax payable. So our tax payable is our tax after our tax credits. And then finally, net income is just our is our income after taxes. So let's have a look at an example here. So Rachel has an annual taxable income of 110,000. Must be nice. Must be nice. The standard rate is 22% of the income up to $80,000, and the higher rate of 42% of income above 80,000. She also has 5,500 tax credits. So what is her tax liability? So tax liability is another word for tax payable. So first we need to find the standard rate. So she's paying 20% on 80,000. She's paying 20% tax on that 80,000. So which is going to be, if I do my calculators right, 16,000. So she's paying 16,000 standard rate tax. Her higher rate at 42%. So she's being charged 42% on all the income she's earned over 80,000, because my standard rate cutoff point was 80,000. So she's earning 40. She's getting 42%. She's taking away 42% of the money. She's getting taxed. Oh, she's getting taxed 42% of the money after 80,000. So she's making 110,000. Therefore, she is getting taxed 42% on the remaining 30,000, which is 12,600. So, and then she has 5,500 tax credits. So her net tax, right? Her net tax or tax payable is going to be 16,000 plus 12,800 minus then my tax credits of 5,500. So it's $23,300 dollars or euro. So she's paying €3,300 in tax that year. So let's look here. So John has an annual taxable income of 295,000. The standard rate cutoff point. The standard rate is 20% on income up to 100,000. Unrealistic. Then 40% on the income between 100 and 200,000, and then 45% on the income above 200,000. He also has €12,500 in tax credits. Was his tax liability or his tax payable? So the standard rate at 20%. He's then paying a high rate at 40% between 100 and 200,000. And then he's paying the higher rate at 45% for anything greater than 200,000. So his standard rate, 20%. So my standard rate cutoff point is 100,000. So he's getting charged 20% tax on his first €100,000, and that is going to be just €20,000. Gorge. Next one, he's now being charged 40% on the money between 100 and 200,000. Well, he is 295,000, right? So he's being charged the full 40% on the full bracket there. So he's being charged 40% on 100,000, which is another 40,000. And then finally, the high rate on the money he's earned after 200,000. So he's paying there 40% on 95,000 because he's 95,000 above the threshold. So find 95% of 95,000, which is going to be 42,750. So let's add up how much he's paying in tax. So he is now has a tax. He's paying tax payable or tax liability. So add them all up of 102,750. Oh my God, would you be sick? Yeah. So he's paying tax of 102,750 for the year. Right. So that is our standard that's just income tax. Now, you are not only just paying income tax, ladies and gentlemen. Unfortunately, that is not how the world works. You are also paying other things like USC, Universal Social Charge, and PRSSI, Pay-Related Social Insurance. So again, these are just more taxes added onto your wages that go to bits and bobs and bits and schools and stuff, right? So let's look at an example here. So Sarah is a self-employed individual who has a gross income of €100,000 in the tax year. She has no dependents and no other sources of income or deductions. So calculate Sarah's net pay after deductions for income, USC and PRSI. The tax rates and thresholds for the tax year are as follows. So income tax, she's paying 20% on the first 35,300 and then paying 40% after that. So she's paying 20% on the full 35,300, which is going to be €7,060. She is then paying 40% on the money she's earned after 35,300, which is going to be 100,000 minus 35,300. So she's paying 40% on 64,700. So she's paying another 25,880 there. Then finally USC. So for the first €12,012, she's paying a half a percent. She's not paying 5, like a half of a percent on that. So it's going to be €12,012 multiplied by 0.005, which is going to be €60.12. Or 6 cents, I should say. She's then, for the next 8,472, she's paying 2%. So on the following €8,000, she's paying 2%. So I'm just going to multiply 8,472 by 2%. So that is 169.44 euro. And then the remaining amount on her income, she's paying 4.5% USC. So we have 100,000 minus the 8,000, minus the first 12,700. What's what 12,012 euro, then minus the 8,472. So she is going to be paying 4% on the remaining 7,956. Then we're going to find 4.5% of that. So I'm going to multiply it by 0.045. 79516 multiplied by 0.045. So €3,578.22. So pay-related social insurance for PRSSI is just 4% of her entire pay, her gross pay, so income, so her pay before taxes. So 4% on 100,000 is just going to be 4,000. And then tax credits, she's not entitled to tax credits because she's self-employed. So let's add all this up. So tax payable. So we're gonna have our income tax plus USC plus PRSI. So it's gonna be 7,060 plus 25,880 plus now my USC, €60.06, €169.44 plus €3,578.22, and then finally plus my PRSI of 4,000. So my tax payable is going to be 7,060 plus 25,880.06 plus 169.44 plus 3,578.22 plus 4,000. So her tax payable is €40,747.72. That's her tax payable. That's how much tax she's paying. So her net pay is going to be 100,000 minus 40,747.72. So her net pay, her take-home pay is €59,252.28 per year. So she's only making just above half of her money there after net pay. Over net pay. Right. And that's it for this video. And I hope it was some help to you. And I'll catch you later. Bye.